it wants to go to 50. I think there's issues with I think there's issues with it. And I think people in the know realize there's issues with it. It's been managed too much for too long. $50, then you probably blow that out and I don't know what happens after that. I don't think it matters too much. I do think, $50 will be better than 38. People then say, well, where will it go after that? I have no idea. I mean, at some point it will go higher than that. But I mean, right now, the way it looks is that like there's something wrong with it. There's something wrong with the trade that's kept it down. And so that's going to break. And it's like it'll go to 50.
Silver prices have reached their highest levels since 2011, with market analysts predicting the start of a historic bull run in precious metals. The white metal's recent surge has captured investor attention as fundamental imbalances point toward sustained price appreciation. Precious metals expert E.B. Tucker anticipates a leveraged rush toward $50 of silver will trigger a brief blowout followed by a pullback that could sideline many investors. Despite expecting short-term volatility, Tucker plans to hold his positions, confident that his silver will soon appreciate significantly. He notes that while silver enthusiasts fixate on the $50 target, it represents only a 33% move, comparable to the S&P 500's recent 25% gain achieved in weeks. Market fundamentals strongly support the bullish outlook. Analysts at GSC Commodity Intelligence state that silver has officially entered breakout mode and $50 an ounce may arrive a lot sooner than anyone expects. This confidence stems from projected demand growth to 5,548 tons by end 2025, while ICICI Securities forecasts a supply deficit of 3,339 tons for the same period. The performance metrics for silver this year have been particularly impressive. The metal has gained 32% year-to-date, actually outpacing gold's 27% gain over the same period. This outperformance highlights silver's unique position in the precious metals complex, where it serves dual roles as both a safe haven asset and an industrial commodity with extensive manufacturing applications. Tucker's perspective on the much-anticipated $50 price target offers a measured view of market expectations. He observes that silver enthusiasts have become overly fixated on reaching this milestone, yet from a percentage standpoint, it represents only a 33% move from current levels. Before we begin, don't forget to like, share, and subscribe. Hit the bell icon to stay updated with all our latest content. You won't want to miss it.
$50. I mean, like it wants to go to 50. I think there's issues with I think there's issues with it. And I think people in the know realize there's issues with it. It's been managed too much for too long. $50, then you probably blow that out and I don't know what happens after that. I don't think it matters too much. I mean, the silver bugs are like hard to deal with because they are really excited about this $50, but it's like 33%. I mean, you just said yourself, the S&P's up 25% in like a matter of weeks. My philosophy is I've got a bunch of silver. I probably wouldn't buy it again. It takes way too much space. I mean, like I have more than my body weight of silver and it's impossible to even keep tabs of it. I mean, I don't even think anyone will steal it because it's too hard to carry. It's nice to have a little bit. I do think, $50 will be better than 38. You don't really have many silver mining companies anymore. Like, I mean, there's a few, but like, there's not enough to have a conference. Put it to you like that. You wouldn't even fill the Ramada banquet room. I know most of them. I like them. I mean, I think like it's a tough business. You got to wonder like why they're in it. Honestly, I mean, if they had invented an app or something, they would have made enough money to buy their own silver mine, I guess, and fulfill that fantasy. But I have it. I own it. I'm not really going to do much with it at 50. I mean, I think, people then say, well, where will it go after that? I have no idea. I mean, at some point it will go higher than that. But I mean, right now, the way it looks is that like there's something wrong with it. There's something wrong with the trade that's kept it down. And so that's going to break. And it's like it'll go to 50. I guess if you want to trade the futures market and try to play that, Godspeed.
And it could be
because
something
you can take it away. Like the futures market is hard because when you trade futures effectively, you totally lose your longer term focus. And then at the end of that, you just have a lot of gray hair and you have stories for people. And I know I've done it myself. I've done it in metals. I've done it in bonds, which if you are short on entertainment, trade bond futures. I promise you, it'll cure your need for entertainment in a hurry. And it's really hard. Like, that's why with Bitcoin, for example, I'm much more interested in owning Bitcoin and have been since 2023 than trading Bitcoin. Because when you have something that's moving and you just own it, you tend to do better than you have something that you're constantly nitpicking to death. Because what's going to happen on this $50 move is that you're going to start moving and you're going to amp up your leverage, and there's going to be a quick blowout. It won't last long, and then you're going to be gone, and then it's going to make the move. And you're going to say, I knew it. I knew it was going to go to 50. Did you have any? Unfortunately, no, I don't. So my philosophy is the silver pile is finally going to be worth a little bit more. And
So
that'll be great. It'll be great.
Yeah, let's hope it gets there, because people are going to lose their minds.
I mean, today it's 38.28 right now. You know, and gold's 33.45. I mean, it's still too cheap. You know, and it's trapped in this like overly financialized world that we're in. That's the problem.
Despite gold's 28% surge this year and junior miners posting 62% gains, precious metals analyst E.B. Tucker argues that mining equities are still underperforming relative to historical expectations. The GDXJ's substantial outperformance of the underlying commodity hasn't delivered the strong leverage traditionally seen during rising gold markets. Gold's impressive rally has been fueled by investor concerns over potential tariffs that could slow economic growth and reignite inflation, driving demand for the safe haven asset as a hedge against rising prices. However, Tucker points to market dynamics that may be limiting miners' ability to capitalize on higher gold prices fully. Wall Street analysts remain cautiously optimistic about the mining sector's prospects. Recent 12-month price targets for GDXJ holdings average $79.76, representing a 15.87% increase from the current price of $68.84. The forecast range spans from $67.26 to $93.15, reflecting varied analyst expectations for the sector's near-term trajectory. Tucker explains that despite gold trading around $3,400, mining companies often receive less than quoted prices due to manipulation in the highly liquid futures market. This price differential between spot and realized prices creates headwinds for mining operations that may not be immediately apparent to investors. Let's get back to the interview.
Yeah, I'm just looking here because because to give you some data, the GDXJ is up 62% this year so far, and gold's up 28%. This is this year, and you were saying last year, which of course we don't have to go into. Like last year, definitely the miners didn't behave. This year, you know, so with GDXJ, you know, you've performed twice as well. Okay, but the old thing was you get operating leverage to the rising gold price, and it means that you do drastically better. And I just don't think you've done drastically better. I mean, it's like the industry is unfinanceable, so it has no access to institutional capital. Of course, the management of these companies will be emailing me to argue this, but we have this infinite pool of money now. Trillions and trillions of dollars. You know, we have like massive amounts of demand for high risk bonds, risky deals, risky funds. And then here's the gold guys are unleveraged, you know, fighting it out in jungle warfare, like bringing this gold back into a highly financialized market. You know, now they're getting $3,400 an ounce for 33.5. I mean, they were getting substantially under what was. I've explained this in the newsletter, by the way. It's like it's a massively liquid market, and so you can move the price around using futures. It's very easy to do. So I mean, you know, it's if you give me, you know, a desk, okay, at the Fed, and you say make the gold price 3,000, I'm going to say, how much credit do I have? And they're going to say as much as you want. I would say, okay, give me like 2 weeks, I'll make it 3,000. So like basically, it's pretty easy to do. And why would you want to do that? Well, because the last thing you want is a blowout gold price that like goes totally bananas. I mean, it makes people like lose faith in saving up money to go to the Coldplay concert. All right. So we need to keep all this glued together. But I think in the newsletter, we own 2 miners. They've done okay. I think they'll do a little better. It's not 2 tiny miners that we think are going to find something. It's not juniors we think are going to get bought. It's two highly respectable miners that make money that are kind of like the new blue chips. Do you notice how like the old blue chips, I'm not going to name names because I know the people that run them, are not really the blue chips anymore. They haven't really done what you would have expected in a previous generation. There's new blue chips, and I think you want to own those new blue chips. It's the same with tech. It's the same with any industry. Like buying what was well managed in the last rally is not a good strategy. I'll tell you what else is not a good strategy is coming up to me at a conference and saying, you liked this stock 9 years ago. Why don't you like it now? Well, that's pretty obvious. And if you read my newsletter, you would know. But things change, just like the gold dealer. They change. And my job, this is the way I see it. This is what I teach my kids. My job is when the facts change, I need to change with them. Okay? Like the faster I can do that, the more successful I'm going to be. Standing around and demanding that Sears come back into business to fix my washing machine from the 70s is not a good strategy. It's a strategy is to say that game's over. Go figure it out and do it fast. And when you do that, your eyes open to the new opportunity. And when you see the new opportunity, you outpace people. And next thing you know, you're in the green room with Coldplay getting, they're asking you, how'd you do it?
Silver is showing strong signs of a significant breakout in 2025, supported by technical patterns and historical price behavior. The metal has surged above long-standing resistance levels, with current price action mirroring structures seen in past rallies that led to sharp gains. Gold, on the other hand, has followed extended cycles of growth and decline. From 2009 to 2011, it experienced a strong uptrend before entering a prolonged down phase, failing to reach a new high for nearly a decade. Both silver and gold remain deeply undervalued in a market dominated by financial manipulation. Despite gold reaching new highs and silver displaying renewed strength, mining stocks have struggled to keep pace due to structural limitations and restricted access to institutional capital. Is gold's strength signaling the start of a bigger move in precious metals? Let us know your thoughts in the comments below. If you enjoyed this video, don't forget to like, share, and subscribe. Only 4.5% have subscribed, so hit the bell icon and turn on notifications to stay updated. Your support helps us continue delivering the latest market insights to you and the entire community. Thank you for watching.